there's actually been an outlier number of engagements in deep out of the money call activity for this February 2026. And I'm talking about strikes at $80 and $85. The disorderly part is now, and it's coinciding with the bankruptcy curve, Hemingway's bankruptcy curve. We're in the steep convexity part of fiat and debt debasement. You're also going to have the gold still doing famously well and getting into double digits of its own, in terms of thousands is what I mean there. So we'll all be bench pressing a lot more and getting pretty strong, at least financially, in the not too distant future. Well, the peculiar thing about America is that they've watched this whole game go down and they've known it go down, which is why I call it a controlled demolition. But now they can't be seen to be allowing themselves to be rugged by China. So there's sort of this last minute rush for everything. So it's now like panic buying. It's like, hey, whoever wants to buy, get in front of them and pay over the odds and secure it. It's almost like last gasp panic. If you value lifestyle, this is why you have to maximize this. And we're going through a contagion shift that's going to happen in a very short time. So this is a unique window where a lot goes on in a short time. Those that are well positioned are made for life. Those that missed it, you're going to wait a long, long time before you ever get an opportunity in such a small time frame to make as much as generational wealth, I'll even say, to see you through the new world order vibes that we're getting right now.
You're watching CapitalCosm. My name is Danny. It is December 9th, 2025, and my guest today is Francis Hunt. Francis, thank you so much for coming on. I mean, you picked a great day, great silver day, $61 at the time of this recording. Go ahead and take it away, my friend. It's all yours. I'm not going to.
You know what, Danny? With every move up in silver, I find I'm actually getting stronger. I was, shoulder pressing about $5,000 a month or so ago. And now I'm managing just as easily $6,000. So, I'm clearly getting stronger with the silver. That's all I can say. I'm loving it. I'm loving it. I'm loving it. I'm expecting, actually, you might need a bigger camera or zoom out lens. I'm expecting I'll be shoulder pressing $7,000 in the not too distant future. And you guys all better watch out when it starts hitting the triple digits, because I'm going to be so hench. You're all going to be running scared.
Well, yeah, I mean, we hit $60 earlier today. Now we're at $61. There isn't any backwardation between spot and futures, but go ahead and talk us through what you see going on here.
Well, we had another continuation pattern. Even I was underestimating its power. I mean, you know us for HVF method. Let's just look at what happened. So we'll do a quick jump. It would be an absolute fail not to jump to the charts on a great day like this. So let's do it nice and early so that everyone can enjoy it. But I mean, that's your daily chart. But on a smaller time frame here.
Oh, I don't see it, by the way. If you want to share.
Hopefully it's showing share screen. There we go. One more time. Let's do that again. Sorry, it wanted permission. That's your little continuation pattern. Yep. It was staring me in the face and damn well all but missed it. Beautiful little upside HVF, and you're breaking higher. We keep getting continuation patterns. In other words, sideways movements, rather than being correct, are kind of corrective. It's like a pullback without going down meaningfully. This was essentially a pullback, and what you're doing is there you are trading 60.712. I would tactically right this very second, not wailing right here. I think it's moved well for today, but in terms of the general move tomorrow, the week ahead, I'm seeing further upside. If you recall, we said 91 is going to be our first point where I think you could stall a little bit for a short while. As we start approaching the foothills of
triple digits. Yes,
I think that's it. I've still got my particular broker on, so we've been live trading. That's so there were some P&Ls in there, but I mean, we really trade. Our community members are at all-time highs. We've been aggressively. I've been telling them this is the trade of the year. It is the biggest performer of the year, silver and gold. I would include platinum in that. It wasn't counted. It's a very small market, platinum. Those are the performers of the year. It's killed everything. It's done a significant multiple on the S&P and many other things. And the one thing I'll say is actually coiling up, which is going to have a real catch-up moment, is when the miners, interestingly, we had this moderate pullback just on the coming into the close. It was about 0.4% there. And some of my favorite equities were down 4% on the downside, the miners, on account of silver ticking down. But they're not up the same beta for this move to the upside. In fact, that some of them are not even at all-time highs. So we are storing up a coiling spring on the miners, the likes of Hecla, Coeur, you name it, First Majestic, Endeavor. There's a list of them. We've got upside setups that have got 10x multiples on them and are looking really good. In fact, let's do First Majestic for you while we're on silver, because I don't always talk about miners with you. I've done a lot of the others on my channel, and I think I've mentioned Hector and some of the others with you more recently. But if we do this fella, which is actually held back, been a bit held back, because Keith Neumeyer's main emphasis as someone who was in the investment banking space was actually, I want to accumulate, I'm scaling for the moment that I think will come. So he probably bought some projects that some would have conceived a little bit subpar for extraction and costs. Jared Canyon jumped straight to mind as some of those, and people would have thought, well, you bought something bad there that other people were prepared to unload. But if you take the macro view that I think he might deserve credit for taking, rather than as a miner and operating efficiency, he just said, listen, even a bad silver mine that's costly to get out, the silver becomes a very good mine when Francis starts bench pressing bigger amounts and in dollars. And we are getting that, same block of silver, bigger amount. It makes bad projects suddenly very good projects because they're priced at the margin, and they suddenly go from being barely profitable to substantially profitable when this prices move in his favor. So I think as a CEO, he had a slightly different mentality to miner operators who really just had lived a long, poor, lean cycle and super efficient. And that is good. Don't ever let anyone tell you that that's not good. But when you're coming into the wall that is the parabola that we're entering, you want all silver ounces, even ones that don't make sense today, will make sense in due course. Price fixes everything in terms of that. And for those of you wondering, so what's the call on it? This is an upside HVF structure using our draw tool. We do all of this in the community, and this is $145 on there. And that's not a close target. That is the first macro major target because this is the first move in an upward trend. So I would close.
What's the price today? What's the price today?
Price today, 15. So we're calling a 10x basically, just under. It was a 10x yesterday. Sorry, it's not a 10x anymore. It's a 9.75x. That's how things are. But we think that's going to be a very, very good move, and price will fix the fact that some of his mines that he acquired had high costs of extraction. And in due course, the fact that he has those silver ounces in the ground, and the valuations are going up as much as they are, certainly going to hold him in good stead. So I'll leave you with that as a miner as well on top of the silver. But happy $60 day to everyone watching this, and hit the like on Danny's channel because he's kept you alert and awake and watching the most important market and the best performing market of the year. So well done to you too, Dan.
Oh, I appreciate it, Francis. Is there any macro factor that you're able to ascertain as to the reason why silver is moving today, or is it just the technicals?
So you're going to get surges. There's going to be more surges. Is there any reason specifically today more so than any other day? I don't particularly see something, but people like to do what I call toe tagging, and they'll jump on so-and-so said something, and that's the reason why silver's gone. If silver's going to 333, it's going through 60 on the way, isn't it? and it's part and parcel. Interesting little tidbits to really get the silver guys a little bit motivated and pumped, because a lot of my messages sound very doomer, because I'm I really just want to talk truth on this channel, hard, cold truth, even if it upsets people. But the one shining light is truth is this block of 100 ounces here, and price discovery is happening. And this makes me smile. And I've got more news for you on that. One thing I've been seeing, and this is coming off the newsreels a little bit, so I'm reporting secondhand, but there's actually been an outlier number of engagements in deep out of the money call activity for this February 2026. And I'm talking about strikes at $80 and $85. So that doesn't mean it's going to happen by February. And I'm not got the expiry date when in February that is, but you could have the possibility holds that it could be, or certain people think that there's a risk of that sufficiently enough to want to hedge against that. So if you were a bank that maybe were structurally short silver in some way, you might hedge by doing that, by buying calls, or you just have speculators with real strong feel. Remember, these people have bought puts. Now, they would have been probably bought in the 50s. That are expiring not far off. Basically, the year is done, aren't we? It's Christmas season right now. Not many shoplifting days left, and then it's January and a little smidge of Feb. And some people are buying calls, thinking, you know what? I either want that lottery ticket, or I want to hedge against a position that's going to hurt me real bad if this thing gets disorderly. So that points to some information that there's extra normal volume there as well.
And it's interesting, it's occurring in the wintertime, like you alluded to. Traditionally, seasonally, the wintertime usually a dull time for the precious metals trade, is it not?
There are annual seasonalities, and all of those go for a ball when you're in fiat debt debasement, convexity downside phase. And this is where we truly are. This is why these things are moving. First, why gold moved. Second, why silver, but silver has the additional aspect to it that I think they've run out of runway in terms of the above ground storage available for industrial use. And it's gone also that China has been accumulating gold aggressively, and in the more recent years has pivoted to getting its citizens to stack silver. So the price of gold is prohibitive for most everyday Chinese. They've been, stacking silver. And you and I both know Eric. He's been sharing a couple of pictures of the guys down at the commodity exchange, tiny little Chinese ladies sitting on trolleys with, the 16 kilo slabs, 7 deep and 10 across, and these guys are saying, here's how I say it. So with that kind of taking the physical out of the system that's gone on, probably driven out of the East, we are now getting true price discovery. And I want to add a bolt an extra point on this. Someone reshared the chart since the 70s. I might be able to even find it. And it was showing that actually people who think this is new, that the gold and the silver has been moving east from the west. This cycle and these events have been planned for a very, very long time. The two charts, if you only bought the open of the US session and closed at the late versus buying at the Asian session, are diametrically opposed. In fact, I think if you had bought the US session only, you would have silver at 15 cents, and you would have on the Asian session silver at $330. And we actually sit with the hybrid of the two here at 60. So one side has been net selling throughout its time, and the other has been, and I'm frustrated that, AI and algos are only really around now. I don't think there's enough time that we could set something to profit from that. But the point being, since the 70s, the precious metals been aggressively accumulated. People have known, we have all known, I've been speaking about this since I was an economic analyst of any variety, wearing much younger clothes. But the point was always when. They kept the control, it's always when. The disorderly part is now, and it's coinciding with the bankruptcy curve, Hemingway's bankruptcy curve. We're in the steep convexity power part of fiat and debt debasement. You're also going to have the gold still doing famously well and getting into double digits of its own, in terms of thousands is what I mean there. So we'll all be bench pressing a lot more and getting pretty strong, at least financially, in the not too distant future.
Why is China telling its citizens to stack silver, and why did the U.S. just add silver to its critical minerals list about a month ago?
Well, the peculiar thing about America is that they've watched this whole game go down and they've known it go down, which is why I call it a controlled demolition. But now they can't be seen to be allowing themselves to be rugged by China. So there's sort of this last minute rush for everything. America apparently just swooped in, and a day and a half before a European delegation was due to arrive to purchase rare earth minerals, and just bought the lot, all of supply just before. So it's now like panic buying. It's like, hey, whoever wants to buy shit, get in front of them and pay over the odds and secure it. It's almost like last gasp panic buying. And, that's not the way you do it. The Chinese are patient. They've been playing the long game. And as I already mentioned, since the 70s, the pricing has always been bullish in the East, far more bullish, and always been sold down for them. The discount window sold down for them. And I've regularly used that phrase. The West is keeping the discount window open for China to acquire real money in lieu of it holding on and not dumping its trillion in treasuries, which is now worth 800 odd billion. And that's how they're being compensated for holding a very illiquid instrument, which many people don't realize. You can't get out of 100 billion treasuries, even though the market cap runs into near hundreds of trillions for treasuries. It's deeply illiquid, and in many instances, as a Californian teacher fund was shown, and as they found out in the previous banking crisis, the Californian banks that went bust, they were encouraged not to sell, but to take loans against their assets. And I think it was Signet, the bank, couldn't sell their treasuries. There just isn't the bid there. It's a rigged market. The only bubble, Danny, everybody needs to understand, because the BIS and the FT came out with articles, gold, silver is a bubble. The only bubble, and the BIS tried to tie the gold and silver to the stock market as a bubble, which is two different concepts in there, totally two different asset classes. The bubble is fiat and debt proliferation. Debt is just fiat with a delayed delivery date and a rental agreement tied to it. That's all. So it's fiat, it's proliferation of magic computer money, and there's a bubble of that. And the debasement has been huge. And that is why gold and silver will look to be disorderly climbing, that people will climb a wall of worry and say, when's the big pullback? No. We're in a parabola of issuance. Cayman Islands might have to buy all of the European and the UK's treasuries. I don't know if you saw that threat. I don't think it's a serious threat because of they wanting to war on in Europe with absolute Looney Tunes leaders. So, I mean, forget everything you see about bubbles on gold and silver. They don't bubble. Everything else bubbles and then collapses, and that's when gold appears to be disorderly moving. And that's what everyone needs to remember.
But aren't you also seeing capital flight from Europe and Canada and into the likes of the Middle East and Asia and even to the U.S. as well? What do you make of this notion that the U.S. will be the last domino to fall?
I think it's incorrect.
Okay.
There certainly seems to be an acceleration in the desire to conclude the controlled demolition of Europe. Everything Germany has done has been absolutely intentionally catastrophic. The leader is, of course, BlackRock, ex-employee, and like Starmer is visited regularly by your New World Order global president that you never voted for, Larry Finkelstein. It's Fink, I believe, but anyway, I have Tourette's. He's absolutely in charge and managing all of these guys, and there is a controlled demolition being push through in Europe, and it seems like they want to push ahead. And I've mentioned the United Kingdom in that with the UK. And there's also this transatlantic rip in the relationship. I don't have a dog in either fight. They're both doomed to die. The key element is I'm sorry for the citizens in both nations. I have family in both. But, this is an orchestrated of intent. I mean, Germany are buying back fuel via India that's being refined in India. That is essentially Russian energy. And paying a bunch more, and, Porsche now are barely breaking even when they used to be a cash hemorrhaging manufacturer. It was one example. So this is controlled demolition. So yes, there's lots of puppetry confusing you about Europe and America. What you have to do is look at the collective West as an insanity bubble that is most ill-prepared for the re-rating of the fiat debt debasement situation, and thereby recognize you don't want to be part or parcel of any of it, and your best insurance is gold and silver in that. By the way, even choosing to live and see it out will see greater hardships, because your government's going to come for you in the various ways that we've mentioned before, such as tax scavenge mode that we've shared with you, which is where they can no longer tax you via inflation. They come aggressively for you via direct taxation, exit taxes, unrealized capital gains, all of these things. So even as a precious metal stacker, you're going to be made to sell to pay excess extraction fees for the welfare state that's coming. Remember, most of your citizens aren't owning gold or silver on any meaningful scale, and many of them are using credit cards. Another little tap on the point we must bypass. The US just crossed 5 trillion in consumer credit, and a large part of that is going on daily staples and maintaining food and grocery budgets, going on high cost credit card debt. That doesn't end well. 5 trillion in that, Danny. The consumer is more wrecked, I think, in America. The policies being led by government are more destructive in Europe. Who falls through the manhole first? It's a moot point, but America isn't the survivor in this. The BRICS nations, those that are actually purchasing, Russia's without a doubt a survivor in terms of its debt situation. China's a good survivor. It's not going to be a great environment for them when the consumer of the world suddenly stops buying because they've been crushed. Don't get me wrong. We're talking about a global depression for everyone, but there's going to be degrees. It's kind of like, the earthquake, where you zone 1, 2, 3, 4, or 10. I'd rather be as far away as possible where the nukes are landing myself, just from the radiation. The people in zone 1 and 2 are being fried, and I'm afraid that's where we are. And that's the doomer part about the silver and the gold price moving up. These things don't happen unless there's real problems are brewing.
Yeah, I'm also looking at the bond yields today. Japanese 10 and 30-year yields slightly down today, but on the aggregate, both are up significantly. Do you see this yen carry trade unwinding anytime soon? Because it seems like Japan is faced with really two choices: either keep the yield carry trade going by monetizing its debt, yield curve control, or by virtue of sacrificing its currency, or saving the currency in this case. Which way do you think they go?
Well, all right, quick break here, because if you're buying gold or silver the normal way, you're probably overpaying by a lot. And that's because most retail dealers quietly tack on these huge markups, sometimes 10%, sometimes 20%, sometimes even 30%. And you don't even notice it. It's like paying $115 for a $100 bill. Doesn't make sense, right? So that's why I've been using the Bullion Standard Pro. It's a membership that basically lets you buy precious metals at real wholesale prices. The same prices that dealers get. So no inflated premiums, no middleman games. Their platform updates every 5 seconds, straight from mints and distributors. So what you see is literally the real market. And here's the crazy part. If you buy something like this gold American Eagle, here's the amount of money you're going to be saving at the time of this recording, at least. So it basically pays for itself multiple folds on many occasions, depending on what you buy. And if you want to try it out, they're hooking up my viewers with an exclusive 10% off their first month. Just use promo code COSM10 at checkout. That's COSM 10 at checkout. So if you're stacking, investing, or just tired of getting hit with hidden markups, check them out now. Boolean Standard Pro. Just click on the link down below in the description box and use promo code COSM10. Now let's get back to the video.
Currently happening, and by the way, we were the first to start talking about Japanese debt long time ago. And as I've mentioned before, they were the most underwatched YouTubes we've ever released. This was in 2021. We called the turning of the debt cycle and said this will be the most significant call that we'll ever make. Silver right now as a break is the most profitable call in any one individual asset. But for effect on everybody, the turn in the late 2020 of the US debt was our most significant call. And we've gone through all the other nations. 21, we were covering Japan and saying at 0.79, we're saying this is going to 6 on the 30 and the 40 year. You're now at 3.5. No one ever saw that. Japan was always sub 1 across all durations. We said the same on Australia more recently. We did a long period of highlighting the EU and the United Kingdom on debt. And now everybody is a Japan rates watcher. And I'm saying we are the news before the news, because we'll tell you what you need to be watching before everyone else isn't watching it. But to answer your question, the yen is also weakening on these rate rises. So as long as the yen is weakening, the payback, even though the interest rates is being squeezed as the Japanese rates close on the US rates, as long as the currency is devaluing, you may have more interest to pay, but your dollar buys you more yen. You're being somewhat compensated. The problem comes when the yen turns, and that will lead to an issue. And for many people that say, but Japan is more indebted, there's a couple of very popular tropes that are incorrect that are out there. Japan, in terms of on-balance sheet items, is officially more indebted than America at about 253%. But when you add in all unfunded liabilities, there is no nation anywhere near the United States. So Japan goes up to around 325 on all GDP. So that's debt to GDP on items that are not yet got any money set aside for them. The US goes from 130 to 550. And other Chicago professors, I'm talking about analysts inside America, not my opinion, have put it at 600 plus. So we're talking about welfare, Medicaid, all of these things are, don't worry, next generation coming up is paying for it through the tax. We haven't put anything aside for it. That is what's called an unfunded liability. The Triffin's dilemma is always the hegemon sends out paper in return for goods. And they have sent out paper and they've kept items off balance sheet. This is an Enron situation. On a far larger case, America is an Enron. The hegemon always falls from the highest ladder and falls hardest. Ask the United Kingdom and the austerity years that followed, the Marshall Plan and World War II, post-World War II. There is no cope, oh, but Europe is more wrecked than us. That's like sitting in the dunce class and getting 19% for your maths paper and saying the clown next to me only got 11%. There's a class behind you, which is the smart kids class that are going somewhere in the world, and they call gold, silver, and platinum. They're not called, USTs versus gilts versus euro bonds, etc., etc. That's all the category of losers. Saying I'm less of a loser than the loser next to me is, it really is scratching the bottom of the barrel. That's not the line of thought. You want to be in a totally different frame. Don't live in that Overton window. You need to be in the frame next door. You're in the smart kids class being taught by the university professor, even though you're still at school, because you're talented. That's gold, silver, platinum, precious metals, and miners. And that's the only way you save. And you need to get out of legal jurisdictions where they can punish you, which they will do, for having taken action to preserve your wealth. And there are other places that will be less draconian than the West, which is spiraling into collapse.
So you would get out of the West but where would you go? What are some ideas?
So sometimes there's two parts to that question. One is it's a bit like divorcing a toxic relationship. Let's say, you're the battered wife to a brutal husband who drinks. Sometimes it's not who's your next husband, it's just get out. And sometimes the first solution, just find a place that's temporary bolt hole. We used Cyprus when I first exited the UK, and that's technically still even the EU, but on the fringes of the EU. But that was just because it was convenient. I had family in other parts of Europe, and I wanted to stay on that timeline, etc., etc. And then we've developed out since then. And we still have a foothold in Cyprus because, interestingly enough, Cyprus has northern Cyprus, which is actually Turkey and not EU. So it gave me that benefit. But I'm not saying that's your model solution. Sometimes you just have to leave, clear your head, take stock, and start building a presence outside and putting distance between you and the toxic wife beater, so that the beatings can stop, if you know what I mean. And even after the divorce, the proceeds to a divorce, get the restraining order, get your distance established. So there is two parts to that question. Then once you're in, a first stop, which is not Western, any place not Western. We're standing in Panama right now. Lovely flat. We've got a flat we live in. We have an apartment we live in, an apartment we work in. It's beautiful. There's lots of expats here. It's great climate, etc., etc., etc. We're off. We've already severed our ties that the little octopus tentacles want to keep holding you. You have a slave master. You were born in America. You have an American passport. Your bank in America. You're everything American. You need some stuff not American, and you need to be out of America to start severing your ties. And Panama is an example, Malaysia is an example. They have a youthful demographic. Bali's all sorts of places, but it depends what kind of person you are. If you might like cold climates and you're an indoors kind of guy, you might be outdoors. There's lots of lifestyle things, but kids adapt, and many times people use family and kids. Your family isn't in a reason to be inert. They're going to realize you were right, and you will be the landing board for them when they want to escape or at least get out for a while. You can always go back home. You aren't saying goodbye forever. You can be a tourist in your own land in the future. So people shouldn't see this as be all and end all decisions. And actually, it's exciting adventure. And I'd encourage more people to take it personally. Just cutting back to your bonds question, though, I just want to highlight this. And this was another thing. We were quite active on X today, as you can imagine, doing our shoulder presses with our 1,000-ounce bars, put us in a good mood. And the thing we were talking about quite a bit was, let's get that share screen. There we go. Finally showed up. Was you got a rate cut, Danny, coming in December.
Oh, that's right.
The US 10-year doing? It's going up, brother.
Mm-hmm.
It's going up. It's going up. And this is the point that we've also always made. And hyper-stagflation, our economic framing for where we are at, explains and handles all of this. Nothing that is occurring is surprising me. Not the move in silver, not our leverage longs making us very wealthy, not our investments making us very wealthy, not our bias against debt, despite everyone saying, but rate cut. Rate cut coming, here you have the 10-year, and this is on a weekly time frame, 2 weeks up. And this is a reversal pattern on its own. If I leave the weekly time frame and show you this, rates are going higher in an environment that your Fed wants to move rates down. So you're actually supposed to have a target of 2%. You're closer to 3% inflation. And at the same time, they are cutting, which is exactly what Powell said, which is the definition of stagflation. Well, in terms of inflation, our rates should be higher. In terms of the job markets, our rates should be lower. So, he's damned by two paths. You actually have two destructive forces that require two entirely diametrically opposite reactions, and that is stagflation, low growth. This is a technical W reversal pattern. We may get a final little shoulder here that will give us perfect symmetry, a little dip down, but that's taking you back up to the 4.5s. at a time that the Fed is cutting rates. Well, the Fed is trying to decree what debt is worth, and the market is saying it ain't worth that, because when they cut rates, you have to pay more and get a less good yield to buy that bond item. People aren't going to buy it. Good luck placing it. Well, very few people are buying it now. The biggest buyer that we found out is recent revelations is the Cayman Islands on a basis trade, which is basically a hedge fund's hyper leveraged use case to eke out a marginal return based off the difference in the futures price and the actual trading price of the treasury at spot. Well, good luck on that one if that's your biggest buyer, who's funding on 24-hour basis through the repo markets. So here's a prediction: more repo market concerns. Two reasons: the basis trade on the 24-hour repo needing more liquidity to keep funding the buyer of last resort, the NSA CIA, based off the golf courses of the Cayman Islands, where the everyday Goldman Sachs hedge fund guy hangs out. And the fact that silver is probably doing immense damage to certain banks right now who have yet to cover short positions. They're going to be tapping for repo liquidity too. I'm really waiting for what I'll get to find out is the Fed has provided in repo liquidity markets over the last few days, including today. That's going to be a really interesting thing. The bond market doesn't care for the Fed. It's doing what it believes is right. There aren't the buyers. The rates are going up.
Speaking of repo market, I mean, you've seen these upticks in repo purchases lately, haven't you? What is that? What is that pretending to?
I'm not entirely sure I'm clear on whether we've seen the same thing. What I have noticed is that the Fed has been providing, apart since 2020, the highest in the last 5 years of liquidity into the system, and banks are clearly drawing it down. And that means the plumbing, interbank plumbing, is running dry. That means people are probably sitting on losing positions, or there's a massive demand, like the Cayman Island hedge funds, for everyday refinancing that's taking a lot of the bank's normally available money, but for interbank lending. So there's stress in all I can say at my top level, and there's better people that'll go into the granularity of the reverse repo markets, is that there's stress in their banking plumbing system. And the one thing people aren't talking about, and I keep making this statement as well, is they aren't talking about the solvency of banks. And I wonder if there's a reason on that, because your balances might get zeroed and we might end up in crisis, and you might have bail-in and a number of things. And eventually the Fed says it's too big, we can't hold it together. Hey, we have to look at extra normal things. Your bank balances were above that. We're giving you a haircut. You now own shares in bankrupt bank for the rest. Something like that. That's what happened in Cyprus, by the way, and we're familiar with that.
Here, check this out, Francis. This is the reverse repo agreements overnight for the last, 25 years or so. And what you'll notice is that anytime you have this uptick in repo, Treasury securities purchased by the Federal Reserve, you've got a major event right after. In 2000, it was a 2000 crash, and right here you saw an uptick here, and it led to the 08 crash. And then on a more recent note, here back in October and September of 2019, this was of course before COVID-19 came into play, and the big, the big liquidity injections leading up to that as well. Now we're seeing a little bit of an uptick as well. So it's kind of ominous. These things only pop up right before a major event.
And the interesting thing about 2020, again, that so few people talk about, is that it was a bank bailout of a grander scale than 2008. People don't realize that. We were so immersed in the medical intervention that we didn't recognize that loans to the tune of 23 trillion were made to all the primary dealers, including Swiss and European banks, by the Fed. Loans. Let's just say those kind of loans aren't the variety they get paid back. They either sustain them until we're ready for all fall down. You had Credit Suisse getting 3.4 trillion. You had one or two banks getting 4.2 trillion. You had 2.9 going to Bank of America, various other trillions. and people just can't conceptualize the scale of trillions. We're talking about, so they may need, it tied them on for a while, but the repo is very much dare we say, the canary in the gold mine for bank health and bailouts. Very, very much. So a contagion event that will justify a bailout again, or the full reset event, is potentially coming shortly. That's what you should interpret that to be. So get your plans in order. That doesn't mean you don't have time. Many people will feel deeply underprepared listening to me and you talk. They're not in a country out of the nation. They haven't got enough gold or silver. Start. All your plans. It's very good mentally to be that one step further ahead than everyone else, regardless. So keep stacking. If you can get a few bricks, do your bench press. You'll be getting stronger every week. You'll be bench pressing even more dollars, and start making plans. Go on holidays to interesting places outside of the Western Union conglomeration, because that's going to be the place that's going to be worst hit.
Yeah, that's a good idea. I mean, at the very minimum, go check some places out, see if you like them. Don't just go move on a whim and then come to find out that you can't live in that foreign environment. But how does you mentioned the reset event happening soon. What does that look like? I mean, what does that really mean?
Who knows the theme? Who really knows the theme? As I say, I'm a man with a YouTube channel far away and an internet connection that just likes to read charts. So I tend to see problems in markets before they happen when I'm on the money, and I can often not be on the money. In terms of what the theme is, we can spitball all day. There's so many things that are liable to break right now. They could choose one of a multitude of options. And of course, the usual geopolitical events. You could get the Euro clowns chasing into war. By the way, the Ministry of Defense in the United Kingdom announced that a British soldier died accidentally in Ukraine. That's a very subtle admittal, overtly, that there is forces actively involved in support of Ukraine. Now, I don't know what that accident is. Who knows? You might end up seeing the drone footage of it on some Russian Telegram group in the not too distant future. But my suspicion is those accidents are going to become more common, and the draft might be called upon, and they're going to slowly wade their way in, because they have been orchestrated to collapse. Larry Fink is quite clearly pulling the strings there, and I don't think he values Slavic life or European life. And there's going to be a flattening. If they go to war, it's going to be body count, and it's terrible. There's nothing more I resent more. I don't say that with any form of glee. I hope not. But that could be a reset-y type vibe, and that will put heat back into an economy, and that'll create a massive demand for resources. So your copper, your brass, when you think of munitions, your silver, when you think of missiles, and then the debasement, the run in debt. Don't forget, as bad as Europe is, and as stupid as our politicians are behaving, their rates are still lower than America, generally, across. We're talking Germany, France, etc. But they've all in upside HVF setups to go higher. I just showed the 10-year to you, and I think that reverses back into the range. And on a macro level, it's got a 6% on it. So one of my big predictions for 2026 is it's the year of 6%. 6% for you, 6 for you, 6 for you. There's going to be too many sixes around for all of our comfort, almost biblical. But you're going to have Japan heading for 6 on their 30 and 40. You're going to have Europe in a similar fashion, particularly the United Kingdom, probably one of the first, but the others joining them on their long ends. And you're going to have the long ends of the US debt also heading in that direction. So that's a lot of additional debt debasement. The good news, again, it show you a different bar for people that are starting. You can get a 10 ouncer, that's 600. I do my biceps with that. I'm not so strong there. The good news is debasement, which is the increase is going to be exceedingly good for gold. So here's another important point. People will tell you, Daniel, that, hey, gold's going to sell off bad and silver's going to sell off bad with any crash. And in 2008, that was the case. But at that time, the bond market was in a secular 40 bull and was the established safe haven. And you had a collapse in rates and a hypervaluation of the debt as the fleeing money fled into debt. What's different now that makes it more like the 70s, a la Nixon carpet bombing Vietnam, to a greater degree than all the munitions dropped in World War II, by the way. Many people didn't know that. The hyper expenditure that went on there. The bond market was crashing then. That's why you got the super bull, the asset, the preservation asset, when the bond market is no longer a safely viewed preservation asset, ergo now, and as in 1970, 71, after the, still mid-flight Vietnam War, were these guys. And what then happens is when people panic out of the stock market, they don't buy the debt. They don't buy the treasuries. Not as much. I won't say there won't be any buying. They go into preservation of capital. And that is the likes of what I'm showing you. Gold, silver, and I feel as well to a large degree platinum. So there's a difference by era. So don't be scared out of your investment in precious metals on account of stock market crash. The only fair trade going forward is gold and silver, not bonds.
Understood. Well, you already answered part of this next question, but I've been asking this question for the last few guests that I'm going to have on for the remainder of the calendar year, and that is any big predictions that you can make. 3 big predictions, Francis. You've already answered one. The 666.
I've got 3.
Okay, yeah.
I'm planning YouTube for the 3 big predictions for 2026. So you're killing the content. Rates 6 by 6 by 6. 6 nations across 6. Calling Australia in there as well. I've discussed that with you. European, I mentioned a number of the majors in there, and the United Kingdom, the long end US as well, etc., and Japan. Monetary metals, industrial metals, cost of living, inflation. The era of inflation coming back hard. And you've got Powell cutting in December. It's going to look a very bad decision in a short time. So the second of our themes is the return of inflation. Cost of living is throttling. I've already mentioned credit cards being utilized as the most expensive money you can utilize just for basic essentials like rental checks and food and groceries. The debt, the consumer debt, I mentioned that as well. You're going to have bankruptcies, liquidations, bankruptcies, ward of state, welfare. At the time the government needs it least, you're going to have the highest unemployment and people being shaken out. You're going to have crashes. Bankruptcies are hitting a high, all of these things. So monetary metals are going to have an unbelievable year next year. Better, I feel, than this year. That's 100% plus you've done this year for silver, by the way. You're going to do better next year, believe it or not. But there's going to be chronic disinflation. Cost of living is going to be the big talk. There's going to be massive social unrest on account of cost of living. So bankruptcies, credit defaults, this is going to be a lot of consumer debt related issues. And I also, as part number 3, think that during next year, we have the AI crash. We have the AI crash and correction, which is another reason why Bitcoin isn't doing particularly well. It needs statist liquidity to pump, and it never got it. The alts never really had a meaningful alt run. Not trying to sprawl into crypto here, but we're going to have an AI-related crash correction on the tech, and there's going to be more and more exposure of, chips being warehoused, supposedly being sold, pipeline stuffing, various other things. Some of the mystique of NVIDIA is going to come away. I tend to think generally, in terms of analysis, someone like Michael Burry is broadly accurate in most instances, usually just early. He underestimates how long the criminals can keep the balls juggled with a fraud. Longer than Michael Burry thinks, but generally he's normally accurate. So for the people that wanted to beat up on him for, saying sell at one point in time, I think he's warranted with more respect than he's given at the moment. And I think he'll be proven correct on the stink he's smelling out of the whole AI trade. So there's three: crash on the AI, major cost of living crisis, personal bankruptcies, absolutely soaring, getting disorderly, a lot of social discontent goes with that. And then the 6x6 on the rates, 6 major nations, all hitting 6%, or 5.75 to 6% range, heading there clearly during the course of next year. Those are three big predictions. And to be frank, in terms of those who positioned well, if you've done well this year, I don't really feel there's too much you need to do. You're in the winning seat. Keep stacking your precious metals. Look at a few miners. And apart from that, I'll look to short with some puts, possibly. I have already some on Palantir, Blue Owl, which is this nasty little SPAC strokes SPV that Facebook was raising debt on, separate to keep off their balance sheets. Their commitment to data centers, all this funny money where they've all panic bought. It feels like what Trump's done in rare earth minerals and the US are trying to do to try plug gaps that China's been quietly positioning for decades, securing supply chain. That everyone's trying to do in a minute. And it feels to me that AI was done like that as well. They all competed together to drive prices up on something they haven't yet monetized. And I think that goes through the dot-com cycle of Amazon going to 106 and back down to 6. And we've got that downdraft to take. So rates will go up on bonds, but at some point, there might be something that'll happen. They might proliferate, and then we'll go inflation cycle again. So you positioned right if you have had a good year. Don't change anything is my take, generally.
All right. Interesting takes as always, my friend. Where can people find you if they want to see more of your work?
Well, our community is doing great. I'm delighted for it. They're well positioned physically, inventory, and also on their trading accounts. A lot of all-time highs, a lot of happiness. I'm glad for that. We don't get everything right. But there are, within these big moves, opportunities where judicious small amounts of leverage. We showed you a little HVF, for example, on the our bespoke methodology for trading, by the way, the squeeze that allows you super tight risk, expansive reward. We start at the YouTube channel, The Market Sniper. We also cover crypto, the Crypto Sniper, and also on our Twitter /X thread, The Market Sniper. There are links there for people to book a call if they would like. Just watch and enjoy first. There's even a free video series that you can get, a daily video for 6 or 7 days with very short 3 to 4 minute videos where you can see what it is we do. If you want to maximize wealth, and Danny, I do feel this is the thing. If you aren't making money, you're dying. Such is the greased pole. You've got to be running fast because the unit of account, $1, is in a massive debasement. And the only reason you're not recognizing it is because the euro and other fiats are too. And we're in a debt and fiat debasement. And that is why these things are moving. And yeah, you've got to be aiming to build wealth. I'm not fascinated with money overly. You know, I live quite simply. I do a couple of sports and things. It's nice to be able to buy whatever you want. But there comes a point, you know, I'm not overly fascinated, but I am by freedom, liberty, being able to move around, travel, do what I want. And unfortunately, that's going to be something you're going to have to pay for in future, which you used to be given for free. And that's a very important thing. So if you value lifestyle, this is why you have to maximize this. And we're going through a contagion shift that's going to happen in a very short time. So this is a unique window where a lot goes on in a short time. Those that are well positioned are made for life. Those that missed it, you're going to wait a long, long time before you ever get an opportunity in such a small time frame to make as much as generational wealth, I'll even say, to see you through the new world order vibes that we're getting right now.
No, I mean, that's a great point because to me, it seems like if you don't get rich now, you're probably never going to get rich at all, ever. And it may even be generational. What you do now with your capital affects your generational wealth, you know, down the line of your family line. So,
and your kids might not get that same opportunity you're going to get, and they're going to be squeezed and extracted from. So you're almost responsible for everybody's lifestyle and your downlines. And I take that kind of seriously, not because I want them to be rich brats, but just because I don't want them to be constrained from doing the right things that really motivate them because of money and the price.
I think there's going to be a permanent peasant class that arises from this on the other side. And if you're not rich, if you're not wealthy, then you're probably going to be part of the permanent peasant class, and you and your family line are not going to be able to escape.
That's what we said in 2017, our most watched video. There is a polarizing event for humanity. And exactly like you said, I sometimes use the word serfs, but peasant is just as good. You're going to be compliant and ward of state and welfare. And the problem is you're never going to get a chance to make enough, scratch enough together that you can start compounding. If you get caught on the downside of that, you can't be caught on the bottom half of this cut. I don't even think it's a half. I think it could be a bottom 90%. You need to be in the top 10, possibly the top 5. Remember, a lot of the third world is already defined in that half, so it's not as scary as it sounds. And there's still plenty of time to do it. And the great thing about these moves is that they're really just getting started, Dan. We haven't done silver against the S&P to show you how early in the move this is. We haven't done the miners against the S&P to show you how early this is. You're going to get real opportunity. Do not fall into a discouraged and bummed out by the message. This should be a galvanizing, motivating message to get going now. It is not. You're all wrecked, and
plus, I presume like most of the people watching this program they're already ahead of the curve just by listening in on people like yourself.
Yeah. Yeah, it's not. There's so much opportunity still to come. These moves, some of these moves are really just early. We're going 4 digits silver. I think the 91 a pause, 333, and then we go over performance into 4 digits. We are on the gold silver ratio, not to drag this video into an extension. We didn't even look at that, but silver's just really breaking out now out of a long period, 3 or 4 years of the 75 to 95 range. We are now just getting, and I'll give you the number where we are with silver's performance today. We're now really just starting to get to 69. We've just broken out of the 70s. Daniel, that has got to go to single digits for me. So, if you think the opportunity's gone, wow, man, this is a 12, the carriage on this train has got 12 carriages. You can hop on any one. You don't have to be on the one on the front. You're going all the way on the journey. This is early doors. We're at 69.49. It's the first time we're in 7. But let me tell you, it's moving fast now. And this is a key moment. It's an exciting moment. Come and join us. Find out what we're about. We can help you maximize your wealth and secure you freedoms and a more globalized footprint outside of the West while still maintaining a very high lifestyle. You don't have to be living in some slum. I'm talking nice, good quality of living standards, possibly even better than what you're accustomed to, especially given that you're going to be growing. Anyway, thanks for having me on. I appreciate it always.
Yeah, here's the silver to gold chart just really quick. We've just barely gotten off the mat where silver just barely beginning to outperform gold. But you look back here in the 1950s, 60s, 80s, where we were at those highs. We were indexed at somewhere around 6.5%, 7% of the gold price. Today we're at 1.4% of the gold price as it relates to silver.
By the way, on that point, I'll just add a final number as a parting shot. I think it was our friend Silver Guru 22 who was sharing production of silver relative to gold. And it was kind of 9s, 8.8, 8.7, different years as we're getting. Then it was 7.3 times the amount of silver ounces to gold. Now we dipped below 7. We're at about 6.9 ounces, 6.9 of these per gold. And that is the mined ratio. Now, bear in mind, it's more than possible to overshoot if it's industrially required to the downside. So if 6.9 is now the new mean, because nobody's going to open up a silver mine that's producing in a year, that doesn't happen. That's a 10, 15, even 20-year adventure. So the production is not going to climb, but the demand is. So people are talking solar is going to account for 40% on its own of all production. That's not including the military-industrial complex, everything else, AI, all the other missiles and things that they want to make. So that's going to be absolutely huge. We could overshoot the 6.9 to the downside. You could even get silver a third of a price of gold.
Wow.
I'm not saying that's a prediction, but typical of markets to overshoot. And if 6.9 is the production mean, and we're at 70 and we're crashing back down to that, and everybody's taking it out of the system and other nations are now doing it, that's starving America. The only thing that fixes it is price, because there is no production. Such a large percentage of silver production is coming out of copper and gold and other mines, which you can't forecast. They're digging the holes for the copper, not for the silver, for the lead, not for the silver. So, they pull out what they get while they're down there. Dedicated silver mines are rare, and they're going to go up immensely in value. And you're going to find entire years worth of production being bought out by governments coming in the not too distant future. That's where I think it is. It's going to become potentially unobtainium until prices a whole bunch higher.
Well said, my friend. Well, on that note, thank you guys so much for watching. Francis, thank you so much for coming on. Always a pleasure having you on. If you enjoyed this podcast, drop us a like, hit that subscribe button, comment, go Francis, go in the comment section, and let me know your thoughts, whether you agree or disagree. Also, drop me your max bench press or shoulder press priced in silver.
Really in dollars, please. Mine only gets better.
Yeah,
we like a bit of inflation in terms of our strength as we age.
So you'll do a little math there. So yeah, convert all the weight into dollars and silver priced in dollars.
Exactly.
Drop me your thoughts below. Hit that like and subscribe, comment, do all the YouTube stuff. It does help in going into the algorithm, pushing us that way. A little bit does go a long way. I really appreciate it. Check us out on Substack too, capitalcosm.substack.com. Get access to all of my stuff early and ad-free, and I will catch you later. Bye, y'all.